Hello and welcome everyone. This is Professor Siddharth Surana. I hope you guys are doing good. और मैं तो हमेशा मस्ती रहता हूँ. Welcome to episode number 9 of revision cum amendments for May 22 and November 22 exams. Previous year 21-22, assessment year 22-23. The last episode of revisions. Because we have already finished PGBP. Along with PGBP, we also completed clubbing set off. So now we are only left with capital gain, other sources and deductions. Last episode of revision. No need to get emotional because I am not going to stop. Tomorrow we are going to come again. And we are now going to continue with our MCQ season 3. More about MCQs I will tell at the beginning of tomorrow's class. For now, let's focus on what we have to complete for the day. So chapter number 36, capital gains, continuing from our handwritten book, Exemption 2.0. Whenever there is capital asset and taxable transfer, both, then only capital gain will arise and you calculate. If there is no capital asset or the transfer is not a taxable transfer, we will not calculate only. We will not calculate whether gain or loss, it will not be calculated only. The calculation of sale consideration minus cost of acquisition will be done only if asset is a capital asset and transfer is a taxable transfer. Where both happen, then capital gain will arise, then only we will calculate and then only we will pay tax. When both happen, then only capital gain will arise, then only we will calculate, then only we will pay tax. So one by one. First, capital asset. What is capital asset? Sub moh maya. Everything is capital asset. All assets, whether movable or immovable, tangible or intangible, fixed or circulating. Securities held by FIIs, even if they are doing regular trading activity, they will be mandatorily classified as capital asset, and thus capital gain is going to arise and the tax treatment in special rates of tax 115 AD it is covered, and ULIP with aggregate premium exceeding 2,50,000 in any of the years will now be a capital asset, and the redemption of that ULIP, the receiving of maturity money of ULIP will be taxable. In fact, STT will be attracted and thus it will be covered in 111A, 112A, wherever the premium has exceeded 2,50,000 rupees, the maturity value will be taxable even if the premium was within 20%, 10%, 15% limit. That means capital asset has not been properly defined. Everything is capital asset. So we have to focus on the exclusion. Stock in trade, because it will be taxable under PGBP. Gold deposit bonds under gold deposit scheme, which was for removal of illegal gold. Special bearer bond for removal of illegal money. Gold bonds issued from time to time. Last example was gold bonds issued under the gold monetization scheme. Rural and agriculture. Rural and agriculture. That means urban agricultural land is a capital asset. And non-agricultural land, whether urban or rural, it is a capital asset. Only rural area and only agricultural land, not a capital asset. Personal and movable. Personal and movable. That means if it is business asset, it will be capital asset. If it is immovable property, it will be capital asset. When it is personal and movable, both, personal and movable both, then it will be treated as excluded from definition of capital asset. But in that also, if it is sculpture, artwork, drawing, archaeological collection, painting, jewelry, SADAPJ, sculpture, artwork, drawing, archaeological collection, painting and jewelry, then they will be treated as capital asset even if they are personal movable. So normally personal and movable are excluded, but these 6 are exceptions. That means immovable will be always capital, business asset will be always capital, and these 6 are personal and movable, still they will be capital asset. Once we know what is capital asset, further discussion about long-term asset, short-term asset, about the holding period, about indexation in long-term capital gain, about 20% tax rate, we already cover it in our NRI taxation chapter. So we are not going to cover that again. Now let's talk about taxable transfer. What are the things under taxable transfer? Sale means anything which is transferred for money. Exchange means barter, anything exchanged for another asset. Relinquishment, extinguishment, when an asset gets destroyed, then it will be taxable transfer, but only if you receive compensation. If you don't receive compensation, then it is not a taxable transfer. Very clever there. If you receive compensation, then there will be gain. So it is a taxable transfer. If you don't receive, that means it will be a loss. So not a taxable transfer. Loss not to be calculated. Calculation will happen only when both have happened, capital asset and taxable transfer. Conversion of capital asset into stock in trade, there is the detailed computation given here. Briefly I will tell you. We purchase capital asset, then we convert it into stock. At the time of conversion, there will be taxable transfer, but there will be no gain that will be taxable right now. This conversion year will only stop our holding period and indexation. stop holding period and indexation. Then whenever we sell our asset in that year, selling price of asset minus the FMV will be PGBP and FMV minus the actual cost will be capital gain. That means this much gain will be taxable under capital gain and this much gain will be taxable under PGBP, but in the year of sale of stock. So at the time of acquisition there will be nothing. In the year of conversion, capital gain has arisen but not taxable because you don't have money, you've just shifted from home to office, capital asset to stock in trade, but it will end your holding period and it will end your indexation. This is important. And whenever we sell stock, there will be PGBP and capital gain both. PGBP will be actual selling price and FMV will be taken as cost price. This FMV will be selling price under capital gain and cost actual but indexed only till the year of conversion. And exactly same computation will happen if stock in trade is converted into capital asset. If stock is converted into capital asset, that means stock converted into capital asset, then this period will be the PGBP and this will be the capital gain. And in case of compulsory acquisition, whenever government takes away your property, that compulsory acquisition will also be a taxable transfer. Again, in the year of purchase, there is no capital gain. Compulsory acquisition, capital gain has arisen, but here also we will postpone. Till which year? Till the government gives you first installment. Compulsory acquisition is taxable in the year of first installment. And what is the importance of the compulsory acquisition here? Again, end of holding period and indexation, because after this, the asset is not with you. And then finally, we will calculate capital gain. When we get our first installment, we will take full compensation because we are taking full cost, but indexation will stop in the year of compulsory acquisition. That will give us our capital gain. And if we receive any balance compensation, because right now we have received only first installment, but we are paying tax on full. So whenever we are receiving balance compensation, then we will not be paying tax on any amount. If an assessee is aggrieved by the amount, he can go and file a writ petition at the High Court. High Court will enhance the order. Then government has option 1, pay, or government can file a further case in Supreme Court. Then Supreme Court order will be final. Whichever is the year of final order, whether High Court or Supreme Court, in the year of final order, you will pay tax on enhanced compensation. Enhanced compensation will be taxable in the year of final order. Initial compensation in the year of first installment, enhanced compensation in the year of final order. In the year of final order, we will be paying tax on our enhanced compensation. Cost is 0 because already taken as a deduction. Only litigation expenses deduction will be allowed. And whether this gain is long term or short term, it will depend on our asset. Gain is long term or short term depends on whether asset is long term or short term. Now, there are some exclusions from the definition of taxable transfer, like distribution at the time of liquidation, distribution at the time of partition, under gift or anything. These are just transactions which are not a taxable transfer. That means capital gain will not arise only. You just have to write not a taxable transfer, therefore no capital gain. Not a taxable transfer, therefore no capital gain. If time permits, you read these points. Otherwise, you can ignore also. These cases you don't have to calculate because they are not a taxable transfer. Once you know capital asset and taxable transfer, now your task is to compute. Like every head of income, there is going to be a pro forma, except IFOS. IFOS, there is no format. Just write them one by one. But here, gross sale consideration minus transfer expense will give us net sale consideration, from which we will subtract cost of acquisition. If long term and not falling in exception, then index cost of acquisition. Long term only you get indexation, but in that also some cases, slump sale, depreciable assets, you will not get it. We will also get deduction of cost of improvement, which is also eligible for indexation, which will give us our gross long term capital gain or short term gain, and from that we will give exemptions from the 54 series, and we will finally get our taxable capital gain. So one by one we will learn the various concepts in the calculation. What is gross sale consideration? Amount received for transfer of asset is GSC, and AO cannot question the adequacy except 50C stamp duty value and 50CA transfer of unlisted shares, where he can take fair market value. Otherwise, he has to take your selling price as the sale consideration. But special cases, in case of barter or exchange, FMV of the asset, remember, very important, asset received will be your sale consideration. What you give, nahi, what you get will be sale consideration. Asset destroyed, then the compensation received, but it is taxable transfer only if received, because if not received, then it's a loss. So not a taxable transfer, no need to calculate. Conversion of capital asset into stock in trade, we already saw fair market value on the rate of conversion. As far as transfer of capital asset by partner to firm or firm to partner is concerned, 45.3, 45.4, we have already seen in partnership chapter. 45.4 has completely changed, complete amendments. So we had taken that recorded lecture from our actual full course, where we explained the full detailed 9B and 45.4 relation. It is still there in the revision lecture. You can see in case of compulsory acquisition, the compensation, initial compensation in the year of first installment, and hence compensation in the year of final order. Joint development agreement, what will be sale consideration? Stamp duty value of new property plus the amount in money in the year of receiving completion certificate. Whenever asset is given in lieu of share, so company is going under liquidation and we give you asset, FMV of the asset received minus the free reserves, because this much is going to be covered as deemed dividend. So this much, the amount to the extent of free reserves will be taxable as IFOS and the remaining FMV will be taxable as sale consideration of your shares. Whenever you transfer immovable property, general rule, actual sale consideration or stamp duty value, whichever is higher. But on the request of the assessee, we will appoint a valuation officer. Valuation officer will always, it is only a table that I have given, but in reality valuation officer will always compute a value between assessee and stamp duty value, and that will be the gross sale consideration. Apart from that, if you have done an agreement earlier and possession is given later, then you can take agreement date stamp duty value also if some amount is received at the time of agreement in the allowable mode. So we have given you the facility of agreement date stamp duty value here if there was some consideration received at the time of agreement in the 3 allowable modes, and if the difference is up to 10% of actual, you always apply this on actual, then we will not do so much magajmari or natak. Directly your actual will be taken as gross sale consideration. For example, actual is 50 crore and stamp duty value is 54 crore. Difference of 4 crore is within the range of 10% and you check the difference on actual, always check on the actual, then we will take your 50 as your answer. But if it is 56 crore, so 6 crore is more than 10% of actual, again we will check, then 56 crore will be our answer. If it is up to 10%, exact 5 crore difference also, we will take 50 crore. But if it was 1 rupee more, then we would have taken the stamp duty value as the sale consideration. In case where an immovable property is held as stock in trade, the same concept will apply, but for computing income under PGBP. In 50C, it is only for capital asset under capital gain, but 43CA is applicable for stock in trade under PGBP. So if the immovable property is held as stock in trade, then we will apply the same concept, actual or stamp duty value, whichever is higher. VO will calculate a value between the two values. Agreement date stamp duty value will also be allowed if some consideration was received at the time of agreement in the allowable mode, and up to 10% difference, then it will be accepted. But there is one additional condition in 43CA. That way 50CA and 43CA are fully same except their head of income, capital gain and PGBP. But there is this one temporary condition, it is applicable only in your attempt from May 23, not applicable if it is a first time sale of residential unit, where it is sale consideration is up to 2 crore. First time sale of residential unit, so land etc. not covered, residential house, first time sale means builder is selling and thus it is covered in 43CA. Understand? First time sale can be done only by the developer, so it will be in 43CA. If it is a subsequent sale, then 50C is applicable. But the condition says only first time sale, so this condition cannot come in 50C, it will come only under 43CA. The transaction has taken place in this period. So you have to ignore the initial period because it was in the last year. Your exam year starts on 1/4/21. You have to focus on this much period. If the transaction has taken place in this period and the amount is up to 2 crore and it is first time sale of residential unit, then we will accept the allowable margin instead of 10%, 20, but only in 43CA. We will not allow this under 50C. So what are the conditions to change the limit from 10 to 20? This thing which was allowed, no, up to 20% of actual. What are the changes? Only under PGBP. Only PGBP 43C, not applicable for 50C. All other conditions are same. Only this is applicable in PGBP. It has to be first time sale of a residential unit, land not covered. Actual consideration should be up to 2 crore. Transaction should be before 30th June 21. Then we will allow you additional 10% margin difference. For example, here it is more than 10%, but within 20%. So here also we will take 50 crore if this was a case of 43CA, not 50C. First time sale, residential unit up to 2 crore. Now here the actual sale consideration is 50 crore. So this cannot apply in this case. But supposingly I change the example to 50 lakh or not even 50 lakh, 50 lakh and 56 lakh. Then the difference will be only 6 lakh rupees. Then it is within 20% range. This example cannot apply because it is 50 crore. It has to be up to 2 crore rupees. And we will allow that additional margin of 10%. For unlisted shares, actual sale consideration or fair market value, whichever is higher. And if it is not possible to determine gross sale consideration, full course students are aware of Deepika Ji example, then the FMV of the asset transferred. We are making a big compromise, but the FMV of the asset transferred will be taken because we do not have any other option available with us. From GSC, we will give deduction of transfer expenses which are wholly and exclusively incurred for the purpose of effecting the transfer, but vague or ambiguous expenses will not be allowed. Cost of acquisition, amount incurred to acquire the asset and all expenses before using the asset for the first time is cost. Eligible for indexation, COA into CII of transfer year divided by CII of year of acquisition by assessee. Cost into CII of transfer year divided by CII of year of acquisition. But here also there are special cases. Whenever the transfer was not a taxable transfer, then we will take cost to the previous owner, holding period also from previous owner. But for indexation, cost previous owner, holding period also for from the previous owner. But for indexation there is a controversy. As per plain language of the law, it starts from the year of assessee, that is current owner. But as per Bombay High Court judgment in the case of Manjula Shah, we will take this also from the previous owner. Whatever you do, you write the note in the exam, and if previous owner also acquired by not a taxable transfer, then we go to the ultimate previous owner for cost and holding period to decide, ultimate previous owner to decide the cost of acquisition. But indexation, same rule will apply. Current owner or previous owner, that you depends, you write a note, you can follow plain language of act, so it will be current owner, or you can follow the Bombay High Court judgment of Manjula Shah, then it will be previous owner. For depreciable asset, the cost will be opening plus purchases. Self-generated asset, that is goodwill, it will be 0, but goodwill of a profession is not taxable. If you want, you can note it down. Any asset which was acquired before 1401, that is before the base year, then assessee will get an option, actual cost or FMV on 1401, whichever is higher, because this FMV will incorporate the indexation before 1401. The cost can be, this cost can be your cost or cost of previous owner. This section will apply to all assets including bonus shares. So bonus shares cost is 0, but if allotted before 1401, you can take the fair market value, but the option will not be available for depreciable assets and self-generated assets. The option will not be available for depreciable assets and self-generated asset. And if the asset is immovable property, then when we take FMV on 1401, it cannot be more than the stamp duty value. So supposingly FMV on 1401 is coming to 2 lakhs, but stamp duty value was only 1,80,000. Then here we will take only 1,80,000. This FMV cannot be more than stamp duty value. Cost of bonus shares will be 0, but if allotted before 1401, then you have the option. If there is rights issue and I directly go and buy existing shareholder, then whatever I pay to the company will be the cost of acquisition. But if I sell my right to an outsider, and with that if the outsider purchases the share, then what is the cost for the outsider? Amount paid to the shareholder for right plus amount paid to the company. Existing shareholder has to pay only this, but outsider will first buy the right from existing shareholder and then buy the share. So this price paid to the company plus price paid to the existing shareholder. In this course, when I sold my right entitlement, for that the outsider paid me some money. Cost is 0 because the right comes free with my shares. Sweat equity shares, FMV on date of allotment, because this much value is already taxed under salary as perquisite. Likewise, a asset received as taxable gift, FMV has already been taxed, so that FMV will be taken as cost of acquisition. If I sell shares of a new company, amalgamated company, for me the cost will be whatever I paid in the old company. Same as business trust. Again, selling price of units, we take cost price of shares. Again, selling price of new company, we will take cost of acquisition in the old company. In case of demerger, because the old and new company exist simultaneously, so what I will do is I will take the original cost of shares, multiply by the proportion which was transferred to the resulting company, that will be my cost of acquisition here, and the proportion which was retained in the original demerged company, that proportion. If I spend 1 lakh rupees in becoming shareholder here, and this company splits into 2 companies because of demerger by transferring 40% of its assets, that means my 1 lakh ka 60% will remain as cost here and 40% will become cost here. Of course, then we will apply indexation and all those things. In case of slump sale, when the entire business unit or undertaking is sold, then only it is slump sale. Then only it is slump sale. All assets and liabilities have to be taken over. If one asset is also remaining behind, then it is not slump sale. There should not be any value assigned to individual asset or liability in the sale deed. It should be one agreement of total. GSC transfer expense, NSC will be all as per normal. Indexation will not be available. And how will we calculate cost? Cost will be net worth of the business unit undertaking that you are transferring. Net worth. How will you find out net worth? Assets minus liabilities. Under assets, depreciable asset we will take WDV, non-depreciable asset we will take book value, and any asset for which you have taken cost as reduction, then already taken, so 0, and minus liabilities. Because the assets include current assets like stock, debtors, cash, bank also, that is why indexation benefit is not available. If there is any advance money forfeited because of a failed property transaction, then then that advance should be subtracted from the cost of acquisition. But if the forfeiture took place from previous year 14-15 onwards, that is AY 15-16 onwards, then the advance money will get taxed under IFOS already, and thus it is not to be deducted. So first of all, why this amendment came? Because it was stating that subtract forfeiture by assessee, and if previous owner had forfeited, then that amount was going untaxed. So what will we do? Any forfeiture, this is the rule, any forfeiture by previous owner, no effect. Any forfeiture by current owner up to 13-14 previous owner, then minus from cost of acquisition, and from 14-15 it has already been taxed under IFOS, so no need to minus. And if cost cannot be determined, so just like selling price, we take FMV on the date of transfer, here we will take FMV on the date of acquisition. After CAUA, we will get deduction of cost of improvement. Any expense that you incur to increase the value of your asset, like addition of a floor or addition of a room, will be allowed as a deduction by calling it cost of improvement, whether it was incurred by current owner or previous owner, both cases it will be allowed. In fact, eligible for indexation also, where index cost of improvement will be COI multiplied by CII of transfer year divided by CII of year of improvement. And that improvement, whether done by current owner or previous owner, doesn't matter. We have to see the year in which improvement took place, and thus Manjula Shah case law has got no impact out here. Depreciable assets and self-generated assets, you will not get it, and any improvement cost before 1401 has to be ignored on the understanding that FMV will incorporate that improvement. But the rule is not that only if you take FMV. Whether you take FMV or you don't take FMV, improvement cost before 1401 will be fully ignored. Whether you take FMV or you don't take FMV, improvement cost before 1401 will be fully ignored. And then we will be getting some exemptions from capital gain. Under section 10, it will be fully exempt. But the 54 series is only if you invest in another asset. Basically, that is like a deduction, but they write the word exemption. No problem. Compulsory acquisition of urban agricultural land. Urban agricultural land is a capital asset. If it was rural, then the topic is over. We don't apply only anything. It's a capital asset. If you sell it, it is taxable. But compulsory acquisition will be exempt, whether it is long term or short term. For individual HUF, compulsory acquisition of urban agricultural land is exempt. And 1037A, Andhra Pradesh Capital City Land Pooling Scheme, it was a temporary thing, and that is going to be exempt. This takes us to the 54 series exemption, where actually it is called exemption, but you get it only if you invest in another asset. So you have a capital gain, which is a taxable capital gain, but if you invest in another asset, then we will give you exemption one by one. Section 54, sale of residential house property. What is the idea here? Sell a house, buy a house. Let's see what are the conditions. Available only to individual HUF. Other assessees can have, but they will not get exemption. They can have property, but they will not get exemption. This exemption is available only against long-term capital gains, long-term capital assets. See, what I am trying to say is, I can buy a property and sell in 1 year. It's a short-term gain. With that money, I am allowed to acquire another house, but I will not get exemption. The condition is not that you are not allowed to do this transaction. The condition is that exemption will be available only if you are individual HUF, only if it is long-term capital gain. Acquire another residential house property. Acquire as many. Exemption you will get only of 1, and that also in India. You can acquire outside India, but exemption only if India. You can acquire 10, but exemption only of 1. Maximum 1 house in India, maximum 1 house in India. And if the units are next to each other, adjacent to each other, which can be converted into 1, then we will not count them as 2 houses. They will be called as 2 units of 1 house, and thus you can take exemption of both of them. Okay, so 1 but next to each other will be counted as 1. And further, this was a lollipop given before 2019 elections. If your capital gain is up to 2 crore rupees, then once in a lifetime you can take exemption of 2 houses. See, next to each other is counted as 1, but if one is in Pune and one is in Mumbai, then they are not next to each other. They cannot be counted as 1. You can take both, but once in a lifetime, and that also if your capital gain is up to 2 crore rupees. In how much time you have to acquire the new asset? Purchase 1 year before or 2 years after the transfer date, or construct within 3 years after the, whatever is your transfer date, you can purchase 1 year before or 2 years after, or construct within 3 years after. And what will be your quantum of exemption? The capital gain or the investment in new asset, whichever is lower. Capital gain or investment in new asset, whichever is lower. But the new asset cannot be sold up to a period of 3 years, and if you sell it, then whatever is the exemption taken will now be taxable. But how will you tax it? From the cost of acquisition of the new asset. from the cost of acquisition of the new asset, we will subtract this exemption. That means that much exemption will be reduced from cost. If we reduce from cost, that means we increase the gain. So in the gain of the new asset, we will have both capital gain of the new asset plus we are also reversing the exemption. The exemption taken on the old asset will be reduced from the cost of acquisition of the new asset. And if it is not possible to purchase before the due date of return, then on or before the due date of return of income, anyways we are giving you 2-3 years ka time, then deposit money in the capital gain deposit account scheme. You get the exemption only if you deposit the money in the scheme on or before the due date, and then you can use the money for acquiring the asset, use the CGDAS money, and you can take the exemption as capital gain or investment in CGDAS, whichever is lower, but use the money within the section time limit to acquire the asset. Otherwise your unutilized amount will be taxable in the year of expiry. This is the main funda, and once the main funda is understood, most of the provisions are just condition wise they are copy, but then the asset which is sold and transferred will change. For example, now we are selling urban agricultural land. Listen, rural is not a capital asset, and urban also only sale because compulsory acquisition is exempt. An individual HUF is selling urban agricultural land, which is a taxable transfer of capital asset. So taxable capital gain, it can be long term or short term, but the land should be used for agriculture for minimum 2 years by yourself or your parents. How will you get your exemption? Purchase another agricultural land. They have just used the word another and not mentioned urban or rural. That means if you sell urban, buy urban, you get exemption. You sell urban, buy rural, you still get exemption. You have to purchase within 2 years from the transfer date. The other points, quantum of exemption, capital gain or investment, whichever is lower. Then you will have to lock in that asset for minimum period of 3 years. If you contravene, then the same calculation, gain exempt earlier now becomes taxable by reducing from the cost of the new asset. But if the new asset is rural, which is allowed, then there will be no calculation. So assessee can escape, and CGDAS will also be same. If there is your industrial land and building which has been compulsorily acquired for all assessees, you can use that money compensation received for investment in another industrial land and building. It can be for long term or short term capital gain. You should have done the industry for minimum 2 years, purchase another land and building within 3 years from receipt of compensation, because it's a case of compulsory acquisition. We will count from receipt of compensation. Thereafter, quantum of exemption, lock-in period, contravention of lock-in period, CGDAS is again going to remain same. Then in 54G and GA, they are actually a copy of each other. Absolutely same. Absolutely same. Only difference is that you are selling plant, machinery, land, building in urban area, and with that money you are shifting. If you shift to rural area, then you get covered in 54G, and if you shift to SEZ, then you shift to and you go to 54GA. The place of shifting, rural or SEZ, is the only difference. Everything else is same. All assessees eligible, whether long term, short term, purchase land, building, plant and machinery. So sell land, building, plant, machinery in urban area, purchase in rural area or SEZ. Rural area then 54G, SEZ then 54GA, and this purchase can be done 1 year before or 3 years after the date of transfer. Quantum of exemption, lock-in period, contravention and CGDAS will once again remain same. And we come to 54EC. Sell any immovable property which should be long term. Immovable property which should be long term, any assessee, and purchase NHAI or RECL bonds or notified bonds of IRFC or Power Finance Corporation, IRFC or PFC. Invest in these bonds within 6 months from the date of transfer. So you will get your exemption, but that exemption will be restricted to maximum 50 lakh. You cannot, there is a lock-in period. You cannot sell, but you cannot convert into money like pledge, mortgage, hypothecation is also not going to be allowed. Lock-in period is going to be same, and capital gain deposit account scheme will not be applicable here because you have only 6 months. So by the time your due date comes, you already know whether you have invested or not invested. So capital gain deposit account scheme not applicable. And finally 54F, sell any asset except house and invest in house. So if you sell house, buy house, then it is 54, but sell anything else, sell land, sell gold, sell shares, sell jewelry and invest in house, then you will get 54F. Individual HUF same as 54, long term same as 54, invest in residential house same as 54. Only difference is that the asset being sold in 54 was house, here it is other. Exemption will be maximum 1 house, that also in India time limit is same as 54, purchase 1 year before, 2 years after, construct within 3 years after. But the main difference of 54 and 54F, and in fact 54F is different from the entire chapter with respect to this, that here you have to invest not your gain amount but your sale amount. You have to invest your entire net sale consideration. Your entire net sale consideration has to be invested. If entire net sale consideration is invested, then entire capital gain will be exempt. Otherwise, proportionate long-term capital gain into amount invested upon net sale consideration. To give you an example, you have GSC 50 lakh 50, transfer expense 50,000. So NSC is 50 lakh, assume cost of acquisition 15. So this is your gain amount. In all other sections, you invest this much, you get full exemption. But here to make 35 0, you have to invest 50 lakh. Same as NRI taxation. Invest 50, 35 will be 0. Invest 25, then it will become 17.5. You have to invest your sale amount in 54F. This is like NRI taxation. Apart from that, there is going to be lock-in period, contravention, everything is same. And in case there is a CGDAS, you can put money in CGDAS. You put 50 lakh in CGDAS, you get 35 lakh exemption because your sale amount. So when the money is unutilized, supposedly this 50 lakh is unutilized, full 50 lakh cannot be taxable. Because of 50 lakh, we took exemption only of 35. Then if 50 is unutilized, then taxable will also be only 35. Whatever proportion exemption we took, only that proportion of unutilized balance will be taxable. And as far as 54 GB is concerned, that you have sold any long-term capital asset which is land or house, and you invest in any eligible company or startup before the due date of filing return of income, then you will be eligible for this 54 GB. If time permits, you can just read this. That's our chapter called capital gains. Let's go ahead to the next chapter, charging section 56, last head of income, income from other sources. Whenever there is income which is taxable, taxable means not exempt, and it is not covered in salary, house, property, PGBP or capital gain, then it will be taxable under IFOS. For example, bank interest, interest on income tax refund, subletting, these are not covered anywhere else, they will be covered here. But some incomes will be specifically taxable under IFOS. Interest on securities held as investment will be taxable as IFOS. Rent from letting out of plant and machinery or furniture, if it's not your regular business, IFOS. Dividend will be taxable. Earlier it used to be exempt, but now it is taxable, IFOS. Gift excluding employer, because employer gift will go under salary, so gift will be taxable. Your gift we will discuss in detail. Winning from lottery, crossword puzzle, card game, everything that is casual winning will be taxable here. Other things you already know, that flat 30%, no basic exemption, no chapter 6 and no deductions. Owning and maintaining race horses, horses will come under IFOS. They have mentioned only horses here. That means if it is race camels or race dogs, then it will go in PGBP. And the only common thing between these two is that both of them are IFOS. Other than that, nothing is same. That means tax will be at normal rates. You get basic exemption, chapter 6 deduction, everything you will get. What is only common between casual winnings and OMRH? That both are under IFOS. Family pension, if employee gets pension, it is salary, but if after death family gets pension, then it will be IFOS. Family pension will be taxable here with a deduction, 1/3 of the amount received or 15,000 per annum, whichever is lower. 1/3 of the amount received or 15,000 per annum, whichever is lower. But this also is not available in new regime. You should be aware of the benefits which are not available in new regime. Okay. But family pension received by member of armed forces who died during duty, these heroes whose picture I have put here, if you don't know them, then the joke is on you. They laid down the lives to save. They laid down their lives to save people. If you don't know them, then the joke is on you, I am telling you. Okay. So they died during duty, family pension will be exempt. Or if any one of them received any bravery award while they were alive, they received any bravery award, then family pension again will be exempt. Interest on compensation, enhanced compensation will go under capital gain, but interest will come under IFOS, always taxable in year of receipt, and from this we get flat 50% deduction. So if you receive 1 lakh, only 50,000 will be taxable. Sitting fees of MP MLA will be taxable under IFOS, but if they get any daily allowance or constituency allowance, that will be exempt. Sitting fees paid to directors to attend board meetings will be taxable under IFOS. See, managerial remuneration is taxable under salary, so 192 applies, but sitting fees is taxable under IFOS, 194J applies. Directors play double role in every company. Any forfeiture of advance money from 14-15 onwards will be taxable under IFOS. Don't forget, any forfeiture which was done up to 13-14, it was not taxable, and therefore we had to do less from cost of acquisition. If there is composite rent, we have already studied this in house property. If you can separate it, then separate it like this. If you cannot separate it, that it will go regular activity PGBP, irregular then house property. If there is any open plot of land, It cannot go in house property. House property requires building. So this can go. If business, then PGBP, otherwise IFOS. Any compensation for termination of employment. This employment need not be from your employer. Employer is giving you, it will go in salary. Supposingly a professional is terminated. Supposingly I engage a CA for 5 years and after 2 years I tell him, no, I am firing you. Then as per contract I am paying him compensation. Something like that. Example. Okay, supposingly I have a business contract but I do a breach of contract. So such cases it will be taxable under IFOS. Royalty income will come here because once you invent your intangible asset, then you are not regularly involved in agriculture outside India. Agriculture income is exempt only if in India. Outside India will be taxable but only for resident, because non-resident foreign income cannot be taxable, as you are aware. From your IFOS, you are going to be eligible for certain deduction. From dividend and mutual fund income, only interest expense will be allowed. So other expenses like bank collection charges or bank charges etc. will not be allowed. Only interest will be allowed. This is tested in recent MCQ, and that also will be restricted to maximum 20%. Only interest expense, that also restricted to maximum 20%. Only interest restricted to 20%. If there are general expenses like you have 30, 31, 37, 1, 32 in PGBP, then all those repairs, depreciation, insurance premium, all those expenses which are incurred for earning IFOS. One general line I can tell you, any expense incurred for earning IFOS will be allowed. And these PGBP criteria fulfilled, expense will be allowed. Not capital, not personal, incurred for IFOS, it will be allowed. That's the general criteria. Family pension deduction we already saw, and interest on compensation 50% deduction we already saw. There will be certain disallowances also. Any expense for casual winnings is not allowed, and anything similar to this. TDS not deducted, then 30%, 100%, direct tax is paid like this. Excess payment to relatives, cash payment to same person same day exceeding 10,000 or transporter 35,000. Certain deductions only on payment basis. Whatever is the PGBP computation rule is also IFOS computation rule. PGBP and IFOS are drastically similar in computation. It's a matter of classification. Many a time there is a dispute whether this income should go in business or IFOS. I'll tell you one thing, it will not make any difference. You put it in whichever head, your total income will be same because the deductions available are same. And tax rate, if special rate is applicable, whether PGBP or IFOS, you have to separate it and apply special rate if special rate is applicable. Okay. Then we talk about the detailed discussion of gift 56-10, Jahapana Tofa Kabul Karo. All assessees will pay tax on gift, whether it is money or asset. But asset covers only selected assets: sculpture, artwork, drawing, archaeological collection, painting, jewelry, bullion, shared securities, immovable property. Only these assets. So car received, watch received, etc. not taxable, and that also for the receiver it should be capital asset. For example, rural agricultural land received. They asked in MCQ, rural agricultural land received. Student thought, sir, it is immovable property, but it is not a capital asset. It has to be capital asset for the receiver. Jewelry gifted to a jeweler, it's stock in trade, not a capital asset, not taxable. For the receiver, it has to be a capital asset, but still certain cases it will be exempt. On the occasion of marriage of individual, that one occasion where even income tax has got sympathy for you. So on the occasion of marriage, any gift received will be exempt. Any gift received due to death, will or inheritance is going to be exempt. Any gift received from a local authority, trust, education institution, exempt. Any purchase consideration at the time of amalgamation, demerger, exempt. Any gift received from relative without any occasion. See, on occasion of marriage, anybody will give you, it will be exempt. Only marriage, not birthday party, anniversary, not divorce, only marriage. But relative giving you any occasion, you don't have to get married for that. Okay, any occasion it will be exempt. Any other notified. Meaning of relative. For HUF, who is relative? Any member. That means member giving gift to HUF, it will be exempt for HUF. Member giving gift to HUF, it will be exempt. But for individual, who will be relative? Spouse, brother or sister of yourself, brother or sister of your spouse, brother or sister of your parents. This was not covered in that chapter, miscellaneous provision. Don't talk about it, you will get confused. Brother or sister of parents. Lineal ascendant or descendant of self. Lineal ascendant or descendant will be same only except if they are stepchildren of spouse, and spouses of the people from 2 to 6, they are our relatives. Listen, if I am member of HUF, my HUF is not my relative. In other words, if there is HUF giving gift to member, this will be taxable because HUF is not my relative. But member giving gift to HUF, this will be exempt because member is relative. Member is relative, HUF is not relative. And now, what about the taxability chart? If it is monetary gift, very easy. You just have to take the total. from taxable sources. So if it is marriage, relative, all those things, remove, make it 0. So you will be left with taxable. Take the total. You don't get 50,000 limit per transaction. If one friend gives 40, other gives 40, you have to take total. If one friend gave on occasion of marriage and other gave in general course, then marriage wala 40 will become 0. So you first take taxable sources, remove the exempt sources, then take the total. If that total is more than 50,000, if it is 50,000 and 1 rupee, fully taxable, not 1 rupee, but full amount will be taxable. If the total from all taxable sources is more than 50,000, then it will be fully taxable. Then let's talk about movable property first. Then immovable, we will take the chart below. No consideration means FMV is fully the gift, and inadequate consideration means FMV minus amount paid will be your gift. If you get it free, then full FMV, and if you get it at concessional price, then FMV minus the amount paid. And rule is same, total from all taxable sources. So remove the exemptions, then take total, apply 50,000 limit. More than 50,000, fully taxable. Remove the exemptions, take the total, apply 50,000 limit. More than 50,000, then it will be fully taxable. Just one thing I would like to tell you, for this category, 50-50 limit is separately available. So if your friend is giving you 40,000 cash and 40,000 gold, cash will come here, gold will come here, both will not be taxable. 40,000 cash, 60,000 gold, gold taxable, cash not taxable. 40,000 gold, 40,000 shares, both come in the same category. You don't get limit per transaction, you get limit per category. 40,000 gold and shares both come here, 80 fully taxable. Idea, for gold you pay 1 rupee, then that will come here. So shares will be 40 here and gold will be 39,999 because you paid 1 rupee and converted from no consideration to inadequate consideration. 40 less than 50 and 39,999 less than 50, both you will save, but this you can do up to maximum of 50,000 rupees. Once you cross the category limit of 50, you have to pay tax on everything. And now let's talk about immovable property. If you receive free, then full gift, but here FMV will be the stamp duty value. Stamp duty value will be the gift, and if it is more than 50,000 per transaction, so under immovable property you get 50,000 limit for every transaction. So if I give you two properties, 160, 140, 60 taxable, 40 not taxable. Here if I give you 60 shares and 40 gold, full 1 lakh is taxable, but here it is per transaction. And if it is inadequate consideration, then what will be the gift? Stamp duty value minus the amount paid, and once again 50,000 per transaction, then it will be fully taxable. Stamp duty value minus amount paid and apply 50,000 limit per transaction, then it is going to be fully taxable. Okay, but for this inadequate case, it is possible that I book my property in under construction and after 5 years I get possession. So at that time I will not pay anything extra. So there will be a difference, no, at the time of agreement and at the time of possession. We will be having the facility to take agreement date stamp duty value, same facility in 50C, same facility in 43CA, same facility here also. Agreement date stamp duty value, if some consideration in those two sections it was the seller, so we said received at agreement. Here it is the buyer buying at less than market price, so paid at the time of agreement in any of the three allowable modes. Some consideration paid at the time of agreement, and here also 10% difference will be allowed. If the difference is up to 10%, then no gift. For example, 2 lakh is the actual value, 2 lakh is the amount that you are paying, 2,30,000 is the stamp duty value, difference is 30,000. You will say, sir, it is more than 10% of actual, but it is less than 50. No, 50 limit is already applicable. If the difference is up to 50, it is not taxable. For taxability, it has to be more than 50 and more than 10%. Let's see this, 6 lakh, 55,000, more than 50, but it is less than 10% of actual. You always apply on actual. Now 5 lakhs, 60,000. Is this different? More than 50,000? Yes, sir. Is it also more than 10% on actual? We always apply on actual. Always apply on actual. Yes, sir. Then this 60 will be fully taxable. And that one thing which was there only in 43C and not in 50C. First time sale of residential unit up to 2 crore during this period, you have to focus only from 1st April, that's your year. Then 10, it will be changing to 20. This 10% will be enhanced to 20%. That condition is allowed in 43CA and 56, but not allowed in 50C. So for the seller under capital gain, it will always be 10% margin. But seller under PGBP, because first time sale, so PGBP, and buyer under IFOS, buyer is buying less than market price, for him it will be IFOS. If it is first time sale of residential unit up to 2 crore rupees in the given period, then instead of 10%, we will apply 20% threshold. And lastly, this very controversial provision, when a private company, closely held company, is issuing shares to resident and the issue price is more than face value, that is, it's a case of premium, and it is also more than fair market value. then the company will have to pay tax on IFOS, not on the entire premium, issue price minus fair market value into number of shares. For example, A private limited, so this condition fulfilled, issuing shares to resident, assume fulfilled, face value 10, FMV 40, so up to 30 rupees premium, no problem, but you issued at 50, so is the issue price more than face value and fair market value? Then you pay tax, not on full 40 rupees, only on 10 rupees, only on 10 rupees into number of shares 1000, so 10,000 will be taxable for the company, 10,000 will be taxable for the company. That is our chapter income from other sources. With this, ladies and gentlemen, as we have already finished the chapters clubbing and set off in the last class, we will move on to the last chapter that I have to do with you, deductions under chapter 6A, and then a little bit about the 3 extra chapters that you have to do, that later, but let's focus first on deductions under chapter 6A. Your gross total income is the total of heads and after doing clubbing and set off, but you have to pay tax on net income. And what is net income? From your GTI we will give you chapter 6A deduction. So if we are subtracting something, it is reducing your taxable income. Obviously they are for your tax benefit, but the maximum deductions will be GTI minus 35AD. From 35AD business you are not allowed to take chapter 6A. Very important, remember for MCQ, if you are in 35AD, from that business you cannot take chapter 6A, and of course already you are taking full cost as a deduction, and any income taxable at special rate with the exceptions that we already know, 80 LA for IFSC and royalty FTS under 115A. Any income at special rate, no chapter 6A deduction. Chapter 6A cannot be claimed. You will get your income related, there is a category called income related deduction only if you file your return on time. If you file your return late, then you will not get deduction. There are multiple categories of deduction. First category is expense related deduction. You will have to spend money. You will have to, only if you spend money, then you get deduction. There is a category other deduction. It is only called category. There is only one section here, 80. So, bola, after 9 episodes, we are also in that condition, 80U. And then under income related, first we'll do one thing, we'll finish 80U and then we'll talk about income related deduction. There is only one section here, any person with disability, only individual, obviously in partnership. I know you are laughing at the expression of this guy, but this guy is the king of expressions. No worry, South people may not be knowing about him. And if you are from rest of India and you don't know him, then that means you are missing something. And I think they should start dubbing their TV serials in South languages. They will be super hit, I am telling you. Superb actor. Okay. Only individuals. You cannot say that partnership deed got, you know, fat gaya, tore, and thus firm should get it. You rubbish. Only individual, flat deduction for normal disability, 40 to 79% disabled, 75,000 flat, and for severe disability 80 and above 1,25,000, irrespective of amount spent. In fact, whether you spend or you don't spend anything for treatment of your disability, some are uncurable. 75, 125. What kind of disability? Cerebral palsy, heavy names they are using. This is something you are comfortable. Bola, hamara faculty is this. Mental retardedness, blindness, hearing deficiency, physically handicapped. If you have any of these disabilities, you will need certificate from an approved doctor, and the certificate should be in force. Then you can take this as deduction 75 or 125. Only called category, but only one section. And now let's talk about income related deduction, which is divided into two categories. Specific income, where you make conscious effort to earn that income. For example, 80QQ before royalty, or other income. You don't put effort. It's like love. It just happens. Ho gaya yaar. 80TT, 80TB. Your money was lying in bank account. Automatically it converted into interest. So under specific income, you have to file your return on time. This is also that deduction that gets added in your adjusted total income 115JC. Example is 80JJAA. If you have profits from processing of biodegradable waste, 100% deduction you will get for the first 5 years. It's a deduction, so after 6th year it will be taxable. And if we talk about the other income related deduction, as I said, that only 80TT, 80TB, it is like love. You don't do it, it just happens. TTA, TTB, deduction against interest income. This is for resident senior citizen, this is for others. Wherever you have higher limit for senior citizen, it will always be resident. Here the maximum limit is 75, here maximum 10. See, difference hai. Here you get flat deduction, irrespective of amount. But here it will be actual interest or 10,000, whichever is lower, actual interest or 50,000, whichever is lower. 50 is only for senior citizen, only if resident, otherwise it will be 10,000. For non-resident also it will be 10,000, HUF it will be 10,000. There is one more secret hidden difference which is very important, because lot of other chapter ka questions will have this adjustment. We have MCQs of NRI taxation which has got this adjustment. Any chapter where there is MCQ, this adjustment can come. TTA is allowed only if it is saving account interest. TTB is allowed against saving, FD, RD, all the interest. Whether the interest is earned from bank, cooperative bank, post office, but this is only saving account and this is for all the three. That's your other income. So we have finished other deductions and other income related. We'll just have to discuss expense related and specific income related. 80C, the most popular of all. Most popular. It affects everyone's life. Available to individual for contribution for self, spouse and children, and HUF contribution for any member. Actual contribution or 1,50,000, whichever is lower. You can make payment from any amount. You can borrow money and pay premium of life insurance. You will still get deduction of the same, even if you make cash payment, because poorest of poor people have this. You just make payment up to 31st of March, then you will get this deduction. Point F is a long list. First point is important, you already know. Up to 31st March 12, the premium limit was 20%. From 1/4/12, it became 10%, but from 1/4/13 for handicap, it became 15%. The other points just to be read once to know what is covered, what is not covered, and out of them, which are to be given more respect and importance. I have already told students in the full course lectures that these are important. You have to take care of them. I'll go to the next section, 80CCC. Tax deduction for individual for investing in pension fund of insurance company. In 80C list, you will get pension fund of mutual fund companies. Here it is pension fund of insurance company. Actual contribution or 1,50,000, whichever is lower. Actual contribution or 1,50,000, whichever is lower. In 80CCD, you will get deduction twice. When you contribute to notified pension scheme, NPS, twice. One, when you yourself contribute, you are eligible. When your employer contributes, you get deduction under CCD2. Let me complete the employer contribution first. This obviously only if you are in job. If I am a self-employed professional, I can have only subsection 1 and 1B. I cannot have only this. Employer is giving me over and above salary. So first it will get added in my taxable salary. Then in chapter 6 I will get deduction. And because it is added in my taxable salary, in new regime it is allowed. In new taxation regime, chapter 6 deductions are not allowed. But there are exceptions. 80JJAA for job creation. 80CCD2. 80CCD2 is there because it has already added in our salary. So you will be allowed actual contribution or 10% of salary, whichever is lower. But if you are central government employee, then 10% limit, 14% will be the limit, and salary will be basic plus DA in terms. When you yourself contribute in 80CCD subsection 1B, you can take 50,000 rupees direct, and your balance contribution will come here. Actual contribution or 10% of salary, and if you are a self-employed person, non-employed, then we will take 20% of GTI. Actual contribution or 10% of salary, whichever is lower, or actual contribution or 20% of GTI, whichever is lower. But always give first preference to this. The reason we already know, it's a revision class. 50,000 that you take here directly becomes your deduction, but this will again be subjected to 80CCE limit, which says 80C plus CCD, 80C plus CCC plus this total will be restricted to 150, and for this there is no such restriction. So always give first preference to first from your total contribution take this 50, then bring the balance here and accordingly take your deduction. If the assessee commutes his pension because of opting out of scheme, then up to 60% will be exempt. And as I already told you, 80C plus CCC plus CCD subsection 1 will have limit, and thus we will give first preference to 1B because any deduction you take there does not have any further restriction. Deduction of medical insurance premium available to individual and HUF. Individual can contribute for self, spouse, dependent children or parents. Both categories will get deduction. Self, spouse, dependent children or parents. Both categories. HUF for any member. Premium will be allowed but not if cash. This category as well as this category. Contribution to government health scheme not allowed here and here. You can take it here. It is not for any beneficiary like self, spouse or parents. Basically it's a donation, and we will subject it to the maximum limit of this category. There is a maximum limit in all the three categories. So the contribution to government health schemes ka deduction like a donation can be taken within the maximum limit of this category. If this category limit is over, you cannot use it over here. You have to take it here. Preventive health checkup, here we will allow you cash also, but only for these two categories, self, spouse, children and parents, only for individual, and these two total will be restricted to 5,000. So supposingly I contribute 4 year and 3 year. If I take 4 year, I can take 1 year. If I take 3 year, I can take 2 year. Where to give first preference? Wherever you have got more balance, there is a maximum total limit. Wherever you have got more balance remaining, you can take over there. And if you are patient in the first category is these people, second category these people, third category any member is a resident, senior citizen, not having insurance. Resident, senior citizen, not having insurance. Then we will allow you to take hospitalization expense also. But only if the patient, see, assessee, I am less than 60. But my mother is also not 60 till now. But in case my parent 60, I don't have to see the assessee, I have to see the beneficiary. So in the first category, it can be these people. It is possible that assessee is 40 years, parent is 65 years old. So you have to see the patient, not the assessee. If the patient is resident, senior citizen, not having insurance. So if they have insurance, you have to take the premium. You don't have the option of taking whichever is beneficial. Only if they don't have insurance, you are allowed to take hospital bill as deduction. Resident 60 years, not having insurance. Resident 60 years, not having insurance. So we will take hospital expense also. The whatever total you get here will be restricted to 25. Total you get here will be restricted to 25. Total you get here will be restricted to 25. So in every category, there is a limit of 25,000. But if you contribute for resident 60 years, again, listen, you can be 40, parent 60, then that category's limit will become 50,000. Supposingly I am 40, parent 60. So this category limit will be 25. This category will be 50,000. Supposingly I am 60, parents 80, then year and year both places I will get 50-50. Supposingly I am 33, my mother is 57, then both categories we will get 25-25. The limit is going to depend on the patient. Patient is resident, senior citizen. Then limit of that category will increase from 25 to 50,000 rupees. This deduction will be allowed only if you pay from your taxable income and if you pay a lump sum bulk premium, advanced medical insurance for 5 years. So you can take the deduction on SLM basis, because 5 years if you pay together, it will exceed the limit. You will lose that deduction in this year. Next 4 years, you are not going to pay anything. So we will allow you to divide it amongst a portion amongst 5 years on SLM basis starting from year of payment. Section 80 DD, if you have a DD, disabled dependent, who you are maintaining, taking care. How are you maintaining? Either you incur expense for his day-to-day maintenance or you take insurance policy with which the DD can be maintained. Expense related, you have to spend money. Assessee can be resident individual, resident HUF. So non-residents not eligible. Whom are you taking care of? Spouse, children, parents. For the first time you have brother, sister also. And HUF is taking care of any member who is disabled and dependent. These people are disabled and dependent and I am taking care of them. Who am I? I am this. This is my family member who is disabled and dependent and I am taking care of this person. I am taking care of this person. Then I will be eligible for 80 DD. Quantum of deduction is flat 75, 125. Normal disability 75. Severe disability flat 125. Quantum of deduction is flat. But I have to spend something. In 80 U, the disabled gets deduction without spending anything. But if I want to take 80 DD, the person who is maintaining, then I have to spend. I spend 1 rupee, still this will be the deduction. I spend 1 crore rupees, still this will be the deduction. But I have to spend something. And of course, you cannot take 2 deductions for 1 disability. So if this disabled is taking 80 U, then I will not get 80 DD. And if I am claiming 80 DD, then disabled will not get 80 U. Only one of them will be eligible to take it. Only one of them will be eligible, and here also you will need certificate from approved doctor. 80 DDB, treatment of big disease like cancer, dementia, leprosy, AIDS, thalassemia, hemophilia, heavy languages. If you spend money for treatment of these big diseases, you will get deduction. You who? Again, resident individual, resident HUF. So 80 DD and DDB deduction is allowed only if the assessee is resident individual, resident HUF. For self, spouse, parents or siblings, or for any member who have to be dependent. So spouse, children, parents, siblings should be dependent. Any member should be dependent. First step will be qualifying amount. Qualifying amount will be lower of actual expense or 40,000. Actual expense or 40,000, whichever is lower. Actual expense or 40,000, whichever is lower. But if the patient, again patient. Assessee can be 40. Patient is resident father 60 years. Patient is resident 60 years. Then it will not be 40, it will be 1 lakh. So actual expense or 40,000, whichever is lower, or actual expense or 1 lakh, whichever is lower. Actual expense or 40,000, whichever is lower. actual expense or 1 lakh, whichever is lower. And that will become your qualifying amount. And from the qualifying amount, you subtract any reimbursement received from insurance company, any reimbursement received from employer. Subtract these two reimbursements and you will be eligible for your 80 DDB deduction of the remaining amount. Any contribution made towards scientific research, rural development, urban poverty eradication by assessees who don't have PGBP. Those who have PGBP can take these benefits, but those who don't have PGBP will get 100% deduction in this section 80 GGA. Any kind of contribution to political parties by companies or other person, political party or electoral trust, GGB, GGC, then 100% deduction will be allowed, cash not allowed. So in PGBP we will disallow whether cash or check, and chapter 6 we will allow only if it is other than cash. If it is cash, then it will be disallowed. Interest on higher education loan allowed only to individual, only interest. This is the only thing that institute tests in exam, only interest. Principal will not be allowed. You can take the loan for yourself, your spouse or your children. Loan taken for self, spouse or children, no maximum limit, full actual interest, only interest, no principal, full amount, and you can take the deduction for 8 years. Whenever you start repayment that year plus 7 years, start repayment that year plus 7 years. So deduction will be allowed for total of 8 years. And higher education means education after 12 which is recognized by central government, state government or local authorities. So coaching classes etc. ka loan not covered. In CA you don't need loan for coaching classes. CA coaching is the cheapest coaching in the country. In CA coaching the only thing now left is please learn from me, I will pay you. That's the only thing left. The kind of fee structure that CA coaching has reached, probably in the near future most people will have to leave this profession and search for other things. The kind of level and the kind of fee structure it has reached, most people are going to be out of it. There are a few handful big, really big sharks here, and they are going to throw out the small and the medium players here. Right now students are very happy. Oh, discount. 3,000 में 6 month subscription, 5,000 में 1 year subscription. 1 year में तो I will watch all the videos. 300 rupees monthly subscription also, unlimited. Right now you are enjoying, but once the small people will be out of this profession, you are like, sir, by that time I will become CA. What do you think that by the time people are out of the market I am still doing CA? But intermediate students still have 3 years. Inter students are also watching. And final also, unless you take it very seriously, you are not distracted, you follow instructions of your teachers, how many years you are going to take? Don't know. If the small and medium people are out of this profession, no, then see what the sharks of the profession do, and then see how much amount you will have to shell out and pay out for any kind of coaching, because anyways institute hardly takes any fees. In CA expenditure is only in coaching. You just wait and watch in the next few years. Once the small people are out, then see how the sharks target the, just wait and watch. Okay, but as of now private coaching classes ke liye CA coaching mein to loan is not required only, so it has to be a recognized education, central government, state government, local authority. Then interest on home loan, we have two sections, EE and EEA. There are some common conditions. Assessee has to be individual in both. It has to be your first house, which is SOP. So obviously you will get only 2 lakh deduction in 24B. First you will have to take that 24B. Both are common conditions. Difference starts from here. If the loan was taken during the year 16-17, still unpaid, you are paying your EMIs, then you take deduction in 80 EE. But if the loan is taken in the present period, 19, 20, 20, 21, 21, 22, then you will be eligible for 80 EE. Here your deduction will be maximum 50,000. So first compute your interest. Take SOP benefit on 2 lakh, you have to give first preference to that. Bring the remaining interest. If you fall in this category, it will be restricted to 50,000. If you fall in this category, 1,50,000. Actual interest of 50 whichever is lower, actual interest or 150 whichever is lower, actual interest after taking 24B. The remaining after 2 lakhs. So if your interest is 2,30,000, bring only 30 here. If your interest is 3,20,000, bring 70 here. That compare with 50 or 150. The stamp duty value of the house in the old section was maximum 50 lakhs, new section maximum 45 lakhs, and loan that you can take is maximum 35 lakhs. Here they have not prescribed any restriction, but to be very honest, if this is the value of the house, the loan cannot be of the full amount. Loan will be about 80% or something, so invariably it will end up falling somewhere in the 30s range only. If you pay home loan principal, you get 80C deduction. If you pay interest, you first take 24B. After that you come here. Interest on electric vehicles, something that our government is again and again trying to promote for individual loan taken during this period. 1920, 21, 22, 1920, 20, 21, 21, 20, 23, Actual interest or 1,50,000, whichever is lower. Actual interest or 1,50,000, whichever is lower. Let me inform you about this. You won't get any other deduction. For example, if your vehicle is purchased for business purposes and you are taking PGBP deduction of the interest already, then you can't take this. And if it is a personal purpose vehicle, you take this deduction, then you don't get PGBP deduction. You can take the deduction only at one of the two places. 80G deduction will be available for all assessees if you pay money in, if you pay money for donation, kind donation like giving land or anything to a trust will not be allowed. If you pay more than 2,000 in cash, it will be disallowed. You have to file statement of donor so that donor gets 80G, otherwise that 234G wala fees will get attracted. Donation has to be to an approved person. There are total 31 categories of donation in which we divide into unlimited category and limited category and further divide into 50%, 100%, 100%, 50%. We have unlimited 100, unlimited 50, limited 100, limited 50. Out of 31, 7 fall here, in which 2 are here and 5 are here, and the remaining 24 will come here, out of which 4 are here, 20 are here. First of all, what is unlimited? Whatever you contribute fully qualifies. Contribution equal to qualifying amount. But here, your actual donation will be restricted to 10% of adjusted total income. What is adjusted total income? Take GTI, subtract 111A, 112 and any other chapter 6A deduction like 80C, 80G, 80C, 80D, 80U if you are eligible. GTI minus these three things, 111A, 112 other deductions, 111A, 112, 111A, 112 other deductions, 111A, 112 other deductions. Subtract this, you get adjusted total income. Do 10%, compare with actual donation, whichever is lower will become qualifying amount. But here, your entire contribution, full amount will qualify. And then what will be the deduction? Qualifying amount into 100%, qualifying amount into 50, qualifying amount into 100, qualifying amount into 50. This part is same except that here there is a maximum limit on your qualifying amount. So let us cover these 4, these 2, these 5, everything else will go obviously in unlimited 100%. Government or local authority for family planning will be limited 100, but for other purpose will be limited 50. If you give donation to Indian Olympic Association or other notified sports body, this is only for Indian company. That means the remaining 30 will be available to all assessees, but this is only for Indian company, limited category 100%. Any notified religious place, temple, church, mosque, gurudwara you give for repair or renovation, limited 50. Any body formed to protect interest of minority community, 6 minority community, Muslim, Christian, Parsi, Jain, Sikh and Buddhist, then limited 50. Any body formed to provide affordable housing, for example Mahada, DD, etc. Any donation to approved charitable trust, all this will go in the limited category 50%, limited category 50%, limited 100 there are only 2, unlimited 50%, unlimited 50 mein contribution to Jawaharlal Nehru, Indira Gandhi, Rajiv Gandhi, any memorials or trust formed in their name, not Rahul Gandhi, there is no Rahul Gandhi memorial till now. Jawaharlal Nehru, Indira Gandhi, Rajiv Gandhi, or Prime Minister Drought Relief Fund will come in 50%. Be careful, you can be confused in exam. There are multiple funds in the name of PM. PM Earthquake Relief Fund, PM National Relief Fund, other funds are also there. If it is the other funds which are created in the name of the PM, then it will go in 100%. Only the Drought Relief Fund will come. National Children's Fund will come here. Any donation to Swachh Bharat Kosh, Clean Ganga or National Fund for control of drug abuse, they are all in the unlimited. Unlimited, otherwise it is very big, but if you have learned these 4, 2 and 5, no need to learn the others. They will all come here, but if they are done for CSR requirement under company law, then not allowed. If done for CSR requirement under company law, not allowed. 80GG you can just read once, not very important. Income related deductions we will do 80IAC, tax deduction for startups. 100% deduction of your profit. So profit, PGBP, GTI deduction. Profit, PGBP, GTI deduction. For how many years? 3 years you will get. But they have to be continuous. So 1, 2, 3, 2, 3, 4. You cannot take 1, 5, 7, 1, 3, 4, 2, 4, 6. No. 3 consecutive out of first 10 years. 100%. So 1, 2, 3, 2, 3, 4, 3, 4, 5, 4, 5, 6, 5, 6, 7, 6, 7, 8, 7, 8, 9, 8, 9, 10 are your only options. 3 years continuous out of first 10. You cannot take 11, 12, 13. Out of first 10, 3 continuous years. Out of first 10, 3 continuous years. And whichever year you are taking deduction, that year's turnover should be up to 100 crore. Eligible startup means doing innovation, development of new products, scalable business, Ola, Uber, Paytm, all these startup based. You watch Shark Tank India, you will come to know what are startups. Eligible startup we are talking about. Eligible startup means a company or LLP which has been incorporated during this period. Earlier they kept 16, 17. Every year they are extending. This year also they extended. You receive certificate from Inter-Ministerial Board of Certification, not formed by splitting up or reconstruction of existing business. Same condition as 10 AA and 35 AD. Maximum second and local hand, plant and machinery 20%. Same condition. Again, CA report will be compulsory. Any inter-business transfer should take place at fair market value, and if the total is more than 20 crore, then domestic transfer pricing will also apply, and you calculate deduction, assume this is the only business. By this we mean that first, before you start taking deduction, if there is, see here it's a startup, so year 1 to 3 may be a loss, year 4 you start taking deduction. So first adjust the losses of year 1 to 3 here, then the balance amount will be your deduction. We are not saying that the losses cannot be taken against other income, they can be taken, but the deduction amount that you get will be taken after adjusting the losses against this profit. 80 IBA, new housing project, and as per amendment, even rental housing projects are now going to get covered. 100% deduction of the profits that you get from the new project, subject to the condition. The project should be approved between this period. This date also they are extending again and again. The deduction will be allowed if the project is completed within 5 years from approval. If there is a plot of land, this should be the only project. You cannot make one affordable housing project and one very big lavish building on the same plot. It should be the only project. You will have to maintain separate books of account. How much I have earned from this project and how much is my other income. Only the profit of this affordable housing project will be allowed. If you sell one house to individual, you cannot sell any other house to that individual, spouse or minor child. Otherwise, what people will do? Buy 2-3 small houses and make it one big house. We want to incorporate a provision for those developers who make small size houses and sell them to poor people. If the house is of large size, then only rich people will be able to buy. So small size houses. So if you sell 3 small houses to individual, he will break the wall and make it one house. Not allowed. Okay. So don't sell any house to that individual, spouse or minor child. Stamp duty value of any individual house cannot be more than 45 lakh. If you are a works contractor, you will be ineligible. There is a developer. Developer puts his brand. Construction is done by the contractor. So developer will be eligible, not the contractor. And some conditions based on the location of land. If the land is in Mumbai, Chennai, Delhi, Kolkata, Bangalore, Hyderabad, National Capital Region, which includes Delhi, Gurgaon, Faridabad, Ghaziabad, all those cities, or Mumbai Metropolitan Region, which includes Mumbai and the nearby cities of Thane, Vasai, Navi Mumbai, Palghar, Mira Bhayandar, these are cities around Mumbai. That's called the Mumbai Metropolitan Region, and other places. Your plot size should be minimum 1000 square meter. Square meter, if you want to convert in square feet, 1 square meter is 10.76 square feet. Minimum, the plot can be bigger. Minimum means it can be bigger. But at other places, there is more land available. So minimum 2000 square feet. On that plot, you are constructing the house. Minimum 90% should be constructed. In other words, you can leave maximum 10% vacant. In big cities, there is shortage of land. So don't make big gardens and all. If you want the garden, shift it to the terrace. Most new buildings in Mumbai have terrace garden, podium garden. On the land, they are not allowed to keep only anything. There is no land, only how we can keep vacant. So maximum vacant land 10%. But at other places, you can keep 20% vacant. That means you can construct minimum 80%. So in metro cities, minimum 90% construction, maximum 10% vacant. In other places, minimum 80% construction, maximum 20% vacant. Then you start making the individual house. The carpet area of the house can be maximum 60 square meter, small size house. And other cities you can make little big, 90 square meter, because rate difference will also be there. And in case there are commercial establishments in the project, you might have to, because ground floor, nobody will buy the house. So if you have to make offices in the ground floor, that will be maximum 3% of the total area. Commercial establishment will be maximum 3% of the total area. Then we come to 80JJAA, a deduction which is allowed in the new regime. Any assessee covered under 44 AB, if you have recruited new workmen. Deduction for job creation, we want to promote everyone. So we are going to give you deduction 30% of your additional employee cost, which we will give you deduction for 3 years. So if you employ someone for 3 years, his salary ka 30% will be allowed as a deduction. 30% of the additional employee cost for 3 years it will be allowed. How will you find out additional employees? If it's existing business, then new employees, not increasing salary of the existing employees, newly recruited people. And if it is new business, then all employees are new only. No? We will pay them salary. Salary will be fully allowed as PGBP deduction. Plus 30% of their salary will be further allowed as Chapter 6 for 3 years. It has to be paid in the 3 allowable modes. Cash not allowed. If you make payment to the following employees, it will be ineligible. Any employee getting more than 25,000 salary is a rich employee. We want poor employees to get jobs. Not allowed. If the government is paying RPF or the employee is not participating in RPF, maybe he is a contract or part-time laborer, not allowed. If you employ him for less than 240 days, then not allowed. Minimum number of days the employee should work is 240 days, but for some industries, apparel, footwear and leather, the criteria is 150 days. So, employee ka salary should be less than 25,000 per month and he should work for minimum 240 days. But in three industries, apparel, leather and footwear, he should work for minimum 150 days. If he works for less than the criteria, whatever be the criteria in the current year, but is employed for the number of days in the next year, then we will treat him as appointed in the second year. Supposingly, I start my business in March. So, I will recruit new employees in March only. They are new employees, but they will work only for 31 days of March. So, I am not fulfilling this condition. I will not get deduction. Year 2, it is an existing business and they are all carry forward employees. They are not new employees because they were already recruited last year in the month of March. So, I will not get any deduction in year 2 also. So, this is unfair to those who employ people at the later part of the year. So, we will assume them as employed in the second year. Current year, first year, they work for less number of days. But second year onwards, they work for more number of days. They will be treated as new employees of second year. New employees of second year. And to compute this deduction, CA report is going to be mandatory. 80M is a deduction for companies. And this deduction is allowed in new regime. 80JJAA was also allowed, 80CCD2 was allowed, 80LA was allowed. 80M is allowed in new regime for companies because deduction is only for companies. So, in 115 BAC BAD, you will not find 80M. But in 115 BAA BAB, you will find this. 80M is allowed to domestic company. This company has received dividend from where? From another domestic company or a foreign company or business trust. Means I am a company and I am getting dividend from another company. I will get deduction of 100% of the dividend received. First, this dividend will go in my IFOS and come in my GTI. Now, I will take deduction. 100% of received, or if I use this money to distribute dividend up to 1 month before the 139(1) due date, or you can say the 44AB due date, because 44AB is 1 month before 139(1). So, dividend received or dividend paid, whichever is lower. Dividend received or dividend paid, whichever is lower. Dividend received or dividend paid, whichever is lower. But dividend paid you will take only up to 1 month prior to the 139(1) due date. That will become the deduction. This was also tested in one of the recent RTP MCQs. 80PA deduction for producer companies, agriculture producer companies is there in your company. Law 100% deduction of profits for these many years if your turnover is less than 100 crore. Only if your turnover is less than 100 crore, you will get 100% deduction of profits for AY 1920 to AY 2425. And if we talk about the 80 QQB RRB deduction, 80 QQB RRB is deduction for royalty income. Step number 1 is to find out your qualifying amount, which will be list of actual royalty income, which we have already written in IFOS because it's a deduction. If you receive it on percentage basis, percentage royalty, then maximum 15%. That means in lump sum cases, 0.2 is not applicable. And if you are receiving royalty from outside India, so how much forex you brought within the allowable time, up to 6 months from end of the year, that is 30th September of assessment year, or the time may be extended by RBI. Within the allowable time, how much forex you are getting. That's the third limit. So listen, only if it is foreign currency, third point will apply. Only if it is percentage, second point will apply. In other words, if it is in India, lump sum royalty, only first point is applicable. That's your qualifying amount. In India, percentage royalty, then first point and second point applicable. Outside India, lump sum, then first point and third point applicable. And outside India percentage, then 1, 2, 3, whichever is lower. Whatever is applicable, 2 and 3 may not be always applicable. If applicable, you take it. Whatever is applicable, you take. Whichever is lowest will become your qualifying amount. And from the qualifying amount, you will deduct expenses. There may be some expenses incurred for earning the royalty income. Deduct those expenses. That will become your deduction. But the deduction will be restricted to 3 lakh rupees per annum. The deduction will be restricted to 3 lakh rupees per annum. And that's our chapter, deductions under chapter 6A. The next few pages are general note. For example, T scheme I have written in a lot of places. Detailed explanation of T scheme was in IT authorities chapter. Issue of notice means it should leave the department, and service of notice means reach the assessee. Agriculture income is exempt only if earned in India. Outside India is taxable, but only for resident under IFOS. If income is taxable at special rate, no chapter 6A deduction with these two exceptions. Always decide whether your capital gain is long term or short term, even if you don't get indexation, because long term has different rates and set of rules. Now you know everything. Okay. If the answer to your question is coming as yes, TDS is deductible in TDS chapter, check every condition, payer, payee, monetary limit, exemptions given, check everything. If your answer is coming as no TDS, monetary limit has not exceeded, no TDS, don't check anything else. Even if one condition is not fulfilled, just say no TDS, finish it off. To say yes TDS, check if all the conditions are fulfilled. Every time there is a question on chapter 6, say, be careful, they will test you on eligible assessee. For example, 80 DD, DDB has resident individual, but 80 C and D have only individual. So you will be tested on that. Eligible assessee, his residential status, beneficiary, some section only children were covered, some place parents covered, some place brother sister also covered, that whether dependent or not dependent. For example, 80D they say parents, so not dependent then also, independent then also. 80D medical insurance they say dependent children, but 80C they say only spouse and children. So that will be tested. And whenever you get higher limit for senior citizen, for example 80 TTA ka TTB 10 ka 50, 80D mein 25 or 50 for senior citizen, 80 DDB mein 40,000 is the normal limit, but for senior citizen 1 lakh. In all those cases, it is only if it is resident. So these are the general points that I have given as notes at the end of my book, and I have also left 2 extra pages. Any student wants to write any note while watching any of the lectures, for that I have given additional pages. At this stage, the chapters in the textbook, 40 chapters of our revision, come to an end. And now to talk about brief about the 3 chapters. There is a chapter base erosion and profit shifting, which is on the BEPS action plan given by OECD. There are 13 action plans given altogether, 13 action plans, 15 action plans given altogether. Out of that, what is an action plan? That the way in which assessee was doing tax evasion. Second, OECD recommended how to stop it. And third, Indian taxation change. So some of the Indian sections like 115 BBD or 115 BBF or 94B in transfer pricing or 286 uniform transfer pricing documentation or equalization levy, all that have come on the recommendation of OECD. Okay. So that's the BEPS action plan, and these sections you have already studied. Next chapter was tax treaties application and interpretation. What are the various ways to interpret tax treaty? Vienna Convention was the most important aspect of that part, and the other rules of interpretation you can only go through. Initial part is same as your DTAA chapter only, and then in model tax convention you had to compare the OECD model convention and the UN model convention. What are the common points? What are the differences? Under OECD model, which country will take tax? Under the UN model, which country will take tax? What are the points of differences? For those 3 chapters, especially this note is only, actually new course students already know what you have to do. All those who have attended lectures from me or anywhere else, this note is only for old course students who are now going to give exam in new course in May 22. In those 3 chapters, we cover them from ICAI study material directly, and at the end of the chapter there are some questions given in the study material itself. Your target or task in life is only to do that much. If you do that much will be more than enough, that much will be good enough. Prepare yourself for that much. At this stage, we complete our revision cum amendment lectures for May 22 and November 22 exams. All those who have been watching all these days, all the 9 days very patiently, thank you so much. You still have to maintain your patience. Next few days we will be covering up our MCQ lectures, and after revision cum amendment, after MCQ, you will be prepared well enough for your exam. Thank you so much all the students who joined me, who watched me. Thank you so much for being with me. I wish you all the best. Do well, make your parents proud, make your teachers proud. Thank you very much for watching. Have a nice night, have a peaceful sleep. Good night please. Bye bye.